Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Richard Wilson, and we are going deep on family offices. Richard founded the Family Office Club, the largest association in the family office wealth management industry. Since 2007, they've been working with family offices by helping them create those family offices, identify deal flow from their live conferences, and connect with quality investment firms and independent sponsors. You're going to learn everything you need to know about family offices and a lot about billionaires now. This is episode 261 of Zen and the Art of Real Estate Investing with my guest, Richard Wilson. Richard is the founder and CEO of Family Office Club, the largest association in the family office wealth management industry with over 100,000 members. Richard, welcome to the show.
Thanks for having me here. Appreciate it.
Yeah, I'm excited to talk to you, and I'm going to start in a different direction. A lot of times I start with the background, but you've talked to so many billionaires. I want to know what separates billionaires from the rest of us and your experience with working with such high net worth individuals.
Sure. Yeah, we have. I've interviewed 45 of them, and then we've closed 19 deals with one billionaire. And
wow.
The number one thing is they're anti-herd. You know, if everyone's doing something, they almost immediately think it must be dumb to do unless it's just table stakes to be in existence, right?
Yeah.
And so they definitely do not try to copy everyone around them. And they're compelled by things that are very unique and aligned with conviction that other people don't have and they are sure on. And something that Peter Thiel talks a lot about, but I see that within my clients that are not famous like Peter. They're voracious learners, and they move lightning fast when they are sure about something. And they don't care if it's unpopular or not what their team thinks should be done.
Yeah, I mean, those are great examples. And the speed to making a decision I've seen is so important because then they can pivot. But they just want to get to action before everybody else who's sitting around, which is very popular in real estate investing, to sit around, analyze for years and years, and then eventually take the plunge when you've missed all the good deals.
Right. Yeah, exactly. Like, the founder of Oak Tree Capital, Howard Marks, in his book, The Most Important Thing, talks repeatedly about how when something's unpopular, it's when it might be a good deal. And when it's so toxic, everyone thinks you'd be an idiot to even touch it. It might be a deal of a decade or a lifetime or a career. So I think that's obviously super important. And, Bezos talks about being decisive. Even at 1 million employees, he tries to be highly decisive.
Yeah.
So I think a lot of that is about trusting your gut and just making sure that you are a voracious learner and focused enough that you really can trust your gut and go fast.
Yeah, don't you think? I mean, of course, they have more money in the end, but even in the beginning, I always feel like high net worth, they look at money differently. They understand what levers to push and what to use money to get and what compounding is.
Right. Yeah, I think a lot of them shy away from things that are selling their time, obviously. And a lot of them have unique ways to force appreciation that work in a down cycle or up cycle. The founder of Keller Williams Real Estate, Joe Williams, has spoken at probably a dozen of our events. And he says, there's no good or bad market. It's just a market you're mostly buying in or a market you're mostly selling in. And if you have a unique game you're playing in a niche that you kind of dominate or with unique strategies, then you're in control of your destiny. It's not like, oh, the market's bad, now we're just going to lose money for years, right? It might be an exciting time.
Yeah, I really think it makes sense because when herds are going one way, it's like you can't get a deal if everybody's looking at that. So outliers are always looking, hey, well, what's everybody missing right now? Or which area can maybe I start in and then improve, especially because with more money, you can accumulate more and increase the value. The art world's a great example. You can just keep buying the same Warhol and increase your own prices. And you can do that in real estate a lot if you're buying in the same areas, multifamilies and things like that, even as you go all the way up the scale.
Right, right. Yeah, for sure. And I think that a lot of people who create the most wealth have gotten really good at playing just one or two games. And they might shift every 7 to 12 years based on like Sam Zell would go to mobile home parks and go to mobile family and shift over big macro trends. But they just get really good at playing one or two games at a time. They're not playing 19 games at a time and just diversifying their income streams. And then, I became a billionaire. It's like, it doesn't really happen that way. And it never happens through your wealth advisor. Their job is to diversify you so you don't mess up too bad and lose that chunk of wealth and just try to track and slightly beat the markets, right? But your wealth advisor is not the solution to what's going to make you rich, obviously, right?
Yeah. Yeah. And I mean, so many high net worth individuals are not people that anybody knows. I think people forget about that just because they're used to seeing, people with a lot or people who are, more celebrities. But if you go back to the millionaire next door philosophy, a lot of the highest worth individuals, nobody has any idea who they are if you just said their name. Am I right about this?
Yeah, no, for sure. I mean, family offices now control $14 trillion. It's more than all of private equity and all of venture capital combined. Yet, if you think about even billionaires, the most famous, the most like hard to hide people on planet Earth, most people couldn't name more than 30 or 50 billionaires.
Right.
And so out of the 3,000 plus, most of them are unknown, right? So imagine people that are only worth a measly 400 million or 80 million, right? There's just so many centimillionaires and decamillionaires out there. It just, the river runs so deep, like you said.
I think it's an important note, though, for people who are at the beginning of their journey and want, have the aspirations of living this type of life, that you don't have to make the life by being outward focused. Social media, of course, didn't exist when a lot of these people were building their fortunes, but I can guarantee you none of them are spending a bunch of time on Instagram.
Yeah, I mean, they say that, wealth whispers and money screams, right? So there's like 10 different ways that people say that. But a lot of people, when they have so many inquiries coming in per day and so many people asking them for things and so many LLCs and K1s and, like every day or two, some letter arrives in my mailbox of some county on some property tax adjustment or something that's due or some LLC. And so the thing is, like, you're not really looking for more of that unless it's high quality or it's giving you the type of deals you want. In general, most people aren't playing that game,
Yeah. Yeah, well, let's get a little bit about a family office in general. What is a family office? We've done a few shows on family office, but it's always good to come back to explain what it is because it's kind of a unique entity inside real estate investing that I don't think your regular investor really knows much about.
Sure. Yeah, I think a family office is really just a solution for managing the investments and wealth of somebody who's ultra wealthy. And the smartest family offices I know manage their wealth in 3 buckets. They have their first bucket of publicly traded, fully diversified assets. They might tell their stock trader that they love or hate Tesla or they like Costco or Amazon, but then they stay out of it and just let them diversify them, right? So that's bucket 1 by One Brain Trust. The second bucket is real estate. And for people that didn't make their money in real estate, it's usually selecting, I like Arizona, Florida, and Texas, or I like the food groups of storage and data centers, whatever it may be. So you're sort of selecting the sectors and the states or regions or some really credible $1 billion plus managers, perhaps. So you're middle of the line involved. But again, you're not directly managing the assets unless you really want to grow your muscle in doing so in some real estate assets right in your backyard or something that you feel like you have expertise in. That's the second bucket. And it's usually 80% cash flowing, 5, 10, 20% real estate development in my experience. And then the third area is really direct investments into the area where the family made their wealth. And again, it could be real estate development if that's where they made their wealth. Right. But if you ran auto dealerships or a manufacturing company, probably you're going to keep on growing your wealth by leveraging the distribution channel you have to Costco or by whatever you did to create your wealth in the first place, right? So that's where they play offense the most. And then they have these other areas that need to be generally managed by different people.
Yeah, and the goal of family offices is really to maintain generational wealth. I mean, the thing that even new parents are thinking of, this is just a larger scale.
Yeah, I mean, like some people have a goal of like, I want to give away all my wealth, or I want to spend every dime so I don't spoil the kids. Or like Warren Buffett says, like, I want to give my kids enough money to do anything, but not so much money they can do nothing. So for some, it's to inspire future entrepreneurism and not just to inspire Ferrari buying and drug taking by kids on Miami Beach that don't have to do anything, you know?
Yeah.
So I think like it is mostly what you said, though. It's like they know how to create wealth. So when they hire other people, it's usually to maintain and grow the wealth. And then they take the most risk on typically within their own niche.
Right.
But they might have a great risk appetite. They made their money in crypto or venture capital, or they're just hungry to really grow their net worth. And some of them are very open to risk.
Yeah, that's an interesting part for you when you're dealing with so many different family office people who run them. The risk appetite can be wildly different. As you were saying, someone who made a boat loan, had nothing, made it on a startup, sometimes their risk tolerance is very high and they can lose and win quickly. And then you have the old timers who are just very happy just putting it in, compound, getting real estate that they know performed. And because they're well capitalized, they can get the assets that they want. You know, they can just bid what they want, or through relationships, which is mostly the family office game, they're just presented with assets that they know, hey, this is a great match, right?
Yeah, I think there's two things related to that. One is you could have the same deal, but have two structures. And one structure is a boring structure.
Yeah.
The other one has more risk, but potentially higher returns. And then you could maybe close both types of investors in one deal. So that's important to remember. The other thing is that family offices really invest into the best people they can find, not the best deals they can find.
Yeah.
I think people new to the industry think, oh, I've got the best deal in the world. Well, first of all, is it the best deal to someone who sees 1,000 deals a month or a year? Maybe not. But the second thing is a average deal presented by an amazing team could make all the difference versus having an amazing deal by an average team.
Yeah.
So much that some investors say who refers the deal to them matters more, or how they met that person matters more than even the merits of the deal.
Yeah.
You know, it's all about the trust.
Yeah, I mean, I found that on a small scale after, years and years of being an active investor, getting into syndications last year and realizing now I just keep investing with the same operators. There's really no reason not to. Like, they're rock solid. It's kind of like when I go to a restaurant, I get something that I know I'm going to like. That's just me. I don't want to. So why with my money, I feel the same way. It's like they've already proven the trust, which is very, very important in family office space, because it's just a little bit more when it's your family entity that you've created. You want to either accept the risk and know what you're getting into, but bet on the operator big time.
Yeah, for sure. And I think that a challenge is there's so much coming at these investors. They're not sure who to trust. And so, Robert Cialdini, someone we interviewed, and he said that they're 16 times more likely to close a transaction if you meet in person with them, if you're trying to sell them or gain a joint venture partner. So even as AI grows and we could be doing everything digitally, we're still putting on 16 events a year so people can meet in person and really see who they're dealing with. Like, everyone can fake anything with AI nowadays. So, it matters even more than it used to.
It's interesting, though, that you brought up Cialdini, because he wrote Persuasion. And Persuasion, I love the book, and it's really about what you do before, but it matters when you go in and then meet in person, how that works, what research you've done and how to do it. And I think that people, as you were saying, these high net worth, they're voracious readers, educators. So they're going to understand when people are going to be more shifty than maybe somebody new who can't really read the room. Right.
And they're really entrepreneurial. So they're used to being sold a bill of goods, or they're used to people trying to sell them something for more than it's worth and be able to smell that out or ask a few sharp questions. Like, these are pretty savvy investors in general. So, we're focusing a lot of time on trying to figure out how do we use big data, the 1,500 transcripts of people that have spoken on stage at our 300 events, and then build out these AI tools that allow people just to sift through things, to figure out who they should even give a chance to trust, or to conduct due diligence faster, or for capital raisers to figure out who to meet with, et cetera. And the busier people get, the more that they need such things. So we've been spending more time on that than anything else lately.
Yeah. Well, tell us a little bit about the events, because I want to relate these large scale high net worth events all the way back to what real estate investors, when they're getting started, should be doing, which is going to in-person events and meeting people who are doing a little more than them, a little less than them, but they're getting in the room with people who are taking action. Why is it so important, even for these people at this level, to get in the room together, do those handshake deals, and just talk about what they're doing?
Yeah, sure. I mean, the one thing to note is that when I started this, I had less money in my bank account than I had due for rent in my little studio basement apartment. And I just learned from the ultra wealthy who are winners in the game of business. They're like super entrepreneurs. And then I implemented the feedback they gave me, what they said on stage. And then now, I've grown my net worth, we've grown our business after 18 years of doing this. So that's one thing, is you can just learn from like the smartest people in business at family offices, right? You're either on a beach or they have a family office and some of the year they're on the beach, right? And so that's basically one big reason. The other reason is that you can turn a horrible deal into an amazing deal if you structure it well. And there's literally 1,000 different deal structures out there that you can consider. And so going down the rabbit hole of deal structures is critical. Knowing how to build trust and relationships, adding value first to family offices, knowing who to go to, how to structure a co-GP, JV deal, how to communicate with family offices and really position yourself uniquely. Like, people come to meet an investor. They're like, oh, I need to find a big investor. I need to raise bigger checks for my deals. Yeah. But the broccoli that we really try to serve them is like, look at the mental models that made these people wealthy. Look at how to talk to them. And now you're smarter at every meeting you go to with a family office, whether you met them through us or not. Like, that's the real value. It's not what people come for initially. They get the investor connections as well. But, the bigger value is like a whole shift in how you operate to appeal to them more.
Yeah. I mean, you want to see the people who are doing what you want to do next and say, oh, okay. Because, I mean, don't you agree? I mean, nothing is unknown. Like, everything that even those people are doing is all things that are tried and true methods. It's just that a lot of people are looking for a quicker way to get there. But sometimes you just need to hear it again. Like, hey, look, I just did the same thing for 22 years, and I put this on top of it. That's what got me successful. And then it kind of helps you relax and say, okay, I am on the right path. Maybe it's slower than I hoped, but I don't think these people care as much about slow, but new people are worried about quickness.
Right. I think what's interesting is when I look at people that built $1 billion plus platform or made $100 million or more, they took unique actions to get unique results. But like, how do they get to taking unique actions that in their environment at that point in time created such massive value? Well, they had to have different thoughts in their head, or they wouldn't have taken different actions, right? So whenever I study, like, I've read 125 books authored by billionaires, and one of the top 3 things that comes up is mental models, mindset, and topics of being a voracious learner, having grit or discipline or vision, anti-herd type mentality. And like that getting those mental models installed and upgraded and always swapping those out. Like Munger says, you should always have 100 models that you're operating off of. That's super critical for doing well, because straight up copying what someone else did, like, well, times have moved on and one niche versus another may be better or worse than it used to be. But those mental models stay mostly tried and true, and you're always tweaking them. But like, the mental models are where all the gold is.
Yeah. How did you get from the basement apartment into the rooms with these people that eventually led to your business now? Because I think that's what a lot of people struggle with. They can't see the light and they don't know how to get there. And it's going to be a different path for everyone. But what worked for you?
Yeah, what worked for me is adding value first. So I studied the industry. I bought familyoffices.com really early on and just had a blog sharing everything I was learning on the industry. So then I started a LinkedIn networking group. We now have 15 million people in our different LinkedIn groups and newsletters, et cetera. And so, but it was all adding value first. It was doing a podcast interview exactly like you're doing now. Yeah. When I got the book deal with Wiley, I was 27 years old and afraid that maybe I didn't know everything about family offices, right? So I was like, what do I do with this in front of me? I have to do it. So I went out and interviewed 30 family offices, put their name in the book so everyone knew that the interviews were real, put the transcriptions in there. And then it positioned me as like, oh, you have this network of family offices. Oh, you talk to more family offices than I do. And I'm a family office. So, and then that got speakers at our events. And I spoke a couple hundred times at other people's events. I started hosting our own events. And so, but the major theme was I was always trying new ways to add value first in a way that would grow my network, build relationships, not burn bridges. It wasn't a sales pitch. It was, here's an infographic. Here's an interview. It's just like what you're doing right now.
Yeah, I think that's so important for anybody at any level to learn, that you have to reduce the sales pitch if you want to add value, because once you do the pitch, the people that you really want to talk to are going to shut you off. I hate being pitched. I love people who just, want to, just have a conversation. I love not getting pitched. You know what I mean? I love that conversation. And there's no end, like there's nothing at the end. I'm like, wow, that was just a nice conversation. We'll stay in touch. And it seems rare now, because everyone, is going to put you on some email follow-up plan. It's like you touch anything online and now you're on a 30 email drip campaign that you didn't want to be on.
Yeah, I think what's critical to realize is that the most valuable people in the world are the busiest. And 5 months ago, I only got 800 emails a day. Now I get close to 1,100 is what my stats say per day. And so with AI tools shooting out emails, machine gun style, even if they're customized, it's just only going to get worse. And so what you need to be able to do is really be the most valuable thing in somebody's inbox so they can not ignore your message. Like, you so hit them between the eyes with just so much value that it's in their best interest to reply to you. And I tell that to people and they're like, oh yeah, we add value because our self-storage fund is so valuable. We're going to make them a lot of money. I was like, no, that's a sales pitch. You completely are not understanding.
They have money. Yeah. It really makes sense, because I've heard Tim Ferriss a lot talk about how he vets guests who he doesn't know already for his podcast. And obviously he's had, huge names of all sorts on, but he says he really reads the email. And if there's anything pitchy in there, he's immediately out. He just wants something unique. And I think everybody wants that conversation with something different, and with background research. Like if you're going to meet with someone who's way above your pay grade, you better do some research before you get in there, so at least you have the background to know what they've done. That's much more impressive to me, and I think to anybody. Do you agree with that?
Yeah, no, for sure. I mean, I saw Tim Ferriss last week put out something on social media, and I agreed with it so much I shared it with my team. He says that like asynchronous communication is key. Not having too many meetings, have an agenda for every single meeting that someone asks you to get on, because 90% of the time when someone wants to catch up with you, it's to sell you something they're doing, or they want you to do something that you never in a million years would do. If you knew that was the request, you never would have gotten that phone call. And many times when I have a 5-point agenda from someone, I'll say, yes, 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 no, maybe. When we get on the call, let's just talk about point number 5, know? And it's an 8-minute phone call instead of 30 minutes of like, let me verbally walk through something you could have read in 30 seconds.
Yeah, I love this, because you're basically backing up my life philosophy. People have always thought I don't answer my phone. I never answer my phone. And my message says, I'm never going to answer my phone. Send me a text. For exactly what you said. I can answer whatever you're asking me in text.
Yeah.
And if not, we'll set a Zoom and then we'll be prepared and we'll have a nice conversation. But the phone does nothing for me. And this is specific to billionaires and to your business. It's crazy to me that people will just pick up a phone and call someone who's not like a good friend. What do you think I'm doing all day? I'm scheduled all day. People who are busy, even work in time for, I'm at the gym. I'm not going to answer my phone. I mean, is this something that you see across the board in all these interviews and people that you talk to, that's not really a good use of time for them?
The most powerful people in the room, when I say these things, they kind of laugh and shake their head like, yes, of course. And the people who are most amateur hour almost get like offended. Like, but you have to build relationships on the phone, or like, why won't you get on the Zoom with me? I'm a member of the investor club. But I tell them, like, by the time that my competition has scheduled a Zoom with you and they show up 3 minutes late to the Zoom and someone can't get their camera working or they're muted, that's 8 days later, and 8 minutes later, I'll reply to you on WhatsApp or text message. Solved. Like, I can be helpful to you right now, not 8 days from now.
Yeah. And I think, that's another thing, though. Technology has changed the way people show up. And for me, like, I still think old school, because I was taught by my dad. I'm always early. And for even online things, I'm always waiting. And if people are 1 second late, I just terminate the call and I'm gone. And I think a lot of people are like that, because if you were showing up in person for an interview with Google, you can't be late. You better be there like half an hour early and prepared. So why wouldn't you be, or why wouldn't you just let someone know, oh, hey, I hit traffic? Like these things are just seem to get like minimized over the years. But I think the people that we're talking about still doing the same thing. They won't accept that behavior because it's a bad use of their time, and their time very valuable.
Yeah, the most powerful phone calls I have the whole year are usually 6 to 11 minutes long. I
Yeah,
had
yeah.
like an onboarding phone call with a billionaire that we might do a lot of work with earlier this week. And that was rare because it was literally a 30-minute phone call. It almost never happens. Like now,
Yeah.
when I catch up with him, it'll be like 6 to 11 minutes, I think,
Right.
almost
Yeah.
every time.
Hey, it's Jonathan. I hope you're enjoying this episode with Richard Wilson as we do a deep dive into family offices. Now, you may not be ready for your own family office now, but if you want to get motivated and explore what Richard has done and all the people he's talked to over his time in this business, go to familyoffices.com. And you can also get all of their social links at the end of the episode. You scroll down to the show notes, and it's all there for you. Let's get back to Richard. Let me get your take on the FIRE movement, financially independent, retire early, because when you know what people are with real net worth, they're all still working. Everybody loves to work because they work in the things that they're passionate about. And I find that this kind of FIRE movement is putting out a very, very bad taste in my mouth for young people. You know, my kids are 23 and 21. They don't follow those principles. They don't agree with them. But I think people are getting coaxed into it as if that means, what are you going to do if you're 28 and you retire? First of all, they're not going to have as much, not that much money unless they hit a startup. But I mean, what are you going to do all day? Just sit around a pool? It seems boring.
Right. Yeah, no, for sure. I find we teach at our investor club, like to make it the most fun year, the most exciting year of your life. If you have a bad product division, a bad employee, a bad joint venture partner, you live in a horrible place, delete all of that because it's probably not working and focus on what you're world class on, your DNA gives you leverage on, you're passionate about, to make you a lot of money, and cut out everything else and just do that, because that's what's going to move the needle. And your subconscious is telling you this is not the life you should be living if you're not enjoying it. Like you're just probably not playing to your strengths, you know?
Yeah, and I think that goes with particular real estate properties, whether it be a luxury home, multifamily. If all you're doing is complaining about it, just sell it at a loss if you have to. Just get rid of it because your life will be better. You know, you can repurpose whatever money you have left in it. It's not like you go from 2 million to zero.
Right.
You know, I think, and I think also, again, like we were saying, everybody that we're talking about, they make decisions quickly. So if they don't like the asset, they're just going to pitch it and repurpose the money and make more instead of waiting years to just, you know, get up a little bit to sell it for a tiny bit more.
Yeah, exactly. Yeah, high velocity entrepreneurs is what I learned from Kevin Harrington and my friend Michael Scott. So Kevin Harrington like created As Seen on TV and was on Shark Tank the first couple of years.
Yeah,
and Michael Scott went from never raising capital to raising $8 million from what he learned in our club, and he had $100 million exit 3 years later. And they both talk about high velocity entrepreneurs is what they look for. That's why people that win keep on winning, because they have that edge of just like acting and execution and speed of implementation. And that's so much about like, you can't learn quickly if you're always just reading and never applying it in real time, you know?
Yeah. Yeah. I've heard that said by Bill Perkins a lot too. It's just like, okay, here's the data. I'm just going to make the decision. I'm going to go. And I think those people, they're going to make it work. Or they'll take a minor pivot along the way, but they're going to be way out ahead, you know, of everybody else who's just, I'm not sure.
That happened to me yesterday. My gut was telling me to do something. You know, Microsoft Copilot, they can't trademark Copilot because there's GitHub Copilot, there's Salesforce's Genie Copilot, whatever it's called. There's all these different Copilots out there. And in the future, I think that there'll just be even more like AI Copilots out there. So we bought like investorcopilot.com and capitalcopilot.com. And it was, you know, 20 grand or something to get those. And it's kind of like, do we need that? Because we already have a different name for our artificial intelligence tool set. These 30 tools we built out. We don't really need it, but it was one of those things where it's like high velocity. It's like, you know what? We'll name one of our 30 AI tools Investor Copilot, like fire in the hole. And like people around me were like, are you sure? I don't know. And I was like, you know what? AI is going to be huge 5 years from now compared to where it is now. Copilots, I think, will just grow in popularity. So we're doing this. Let's go. You know, and you know, it wasn't like $1 million decision, but I think on a micro day-to-day basis, you know, you have to move with conviction and trust your gut on things like that.
Yeah. And again, I think this is like great trickle down advice for somebody who's never even invested in anything, is building up their capital now. Like, you don't rush to do something, but keep doing your due diligence so you can get ready instead of kind of finding every way to procrastinate, which a lot of people do in their lives as well, which nobody that we're talking about does.
Right. Yeah, for sure. I mean, Bezos does a great job of talking about like reversible decisions, right? Like, is it something that could literally sink my entire business? Yes or no? Okay, well then maybe pump the brakes a bit if it's something that could, right? Like, but if it's something that's, worst case, you sell it off to someone else who could strategically use it, even if you do lose 10K or 5K or all 20K,
right.
like, no big deal in the scheme of things. It could be amazing in the future. Like when I bought familyoffices.com, I was a broke small business just getting started, and that felt kind of risky. And everyone said I was ridiculous to pay $138,000 for privateequity.com, but then we sold it to someone in Hong Kong for just under $500,000. And, it worked out. But literally everyone around me told me that I'm being ridiculous and like I've lost my mind, and so doing things like that take courage. And most of the time when you create value, it takes, like Mark Cuban says, no balls, no babies, right? I mean, it's like a crude way of saying it, right? So it's like you have to have courage.
I love the way he talks, though. I mean, it's just quick and to the point. Like,
him and Tillman, I love their books and the way they talk. They have like a bit of a sense of humor. They don't care if they offend 10% of people. It's like, here's what I think. Take it or leave it,
Yeah, but didn't you feel like when you were getting negative response to you buying the website that I feel like you knew you were going in the right direction? That's how I feel now. Of course, when you don't have as much experience, you're still hemming and hawing. But now it's like, if I get negative feedback, I'm like, I'm definitely doing the right thing.
Yeah. It's like, oh, good. Not everyone agrees with me. That means you're late to the game. That means that like something might go down because everybody is doing it. Right. So definitely have to have courage to take those bets and stakes and really go deep on something. Like there's been a couple times the last 18 years where I knew I was getting a little bit lucky. And then you just put the gas pedal down and you go as deep as you can and think, if I was competing against someone who's very competitive, how deep would they go? And then go deeper than any reasonable person would go, and then go way deeper than that. And that way it's like, no one's going to go that deep. It's too ridiculously deep to go. And then that's how you beat other people in a sandbox, I found.
Yeah. So when it comes to real estate investing, when you're dealing with family offices, are they generally looking for more generational assets, what I would call more asset hunting? They're not looking for something generally that will turn over quickly, or are they interested in that depending on the profile or kind of allotment of what everything looks like in their diversified profile?
There is a segment of a family's portfolio where they like to hold some legacy assets, usually directly, like, hey, let's buy these 1,000 acres in the Midwest, or let's get this boutique castle-looking chalet, property. There's a percentage that they do buy things like that, or let's buy this strategic asset for our auto dealerships. It'll take a decade to pay off, but then everybody's going to want to do business with us. Like they do have those types of like strategic choke point or legacy big acreage trophy asset things. But that's probably 5-7% of where their energy goes. I think that when there's volatility and in a market like right now of where politics and world affairs are, they really appreciate if something gets them all their money back off the table in 1 year or 18 months or 1 to 3 years, because it balances out all the 4 to 7 year private equity deals that turn into 12-year, 10-year plus things that take a long time to unravel sometimes, that they're not in control of when they unravel. So they like having that balance. They appreciate that, because for so long, the private equity world's been like, 4 to 7 years, and we'll see what happens and if it's the right time to sell,
Yeah, and I think based on what we were talking about before, it's also important to note that the more stable assets you have, the more your risk tolerance can go up, because it becomes like a diversification balance to the portfolio. Like people who invest in startups, of course, you're going to lose on a lot of them. But if you hit one, you've just hit the jackpot. So it's kind of leveraging what the goals of the family office are and how to diversify the whole portfolio, also considering the 3 buckets that you talked about at the beginning.
Yeah, I think that related to what you just said is investors leaning forward when they see an asymmetrical return. And something we tell investors all the time, or anyone raising capital, that if you get to see deals first or exclusively or at a better valuation, that's typically because you're either positioned very well, your relationships, or you're adding strategic value. So people want you on the deal. So they'll show you the deal first exclusively or at a better valuation because you add brain power and you're not just a checkbook. And so If you can do that, then your wealth grows tremendously and you get asymmetrical returns because you can force the appreciation, you can add value, you can open doors, you can de-risk, you can structure the deal custom, you can add it to your strategic portfolio. If you own 1,000 units of single family residential and some new tech device, some real estate tech device comes out and you can test it out on 100 homes to save energy, now you can beta test it before you invest. And then when you invest, put it in all 1,000 homes and get their revenue to a decent stage just within your own portfolio, right? So stuff like that, is massive. If you've sold a portfolio of $100 million in self-storage, then somebody who owns 2 locations and wants to grow, they want to be you when they grow up. And if you are down the path, like we were talking about earlier, they want your money, not some random person's money who's going to complain and ask where the report is and not understand the industry. That's like a negative value,
Yeah. Is there an asset class that you feel like every large scale investor should have as part of their portfolio, just looking at what the markets look like now in 2025?
In terms of real estate niches?
Yeah.
Yeah. My personal preferences might differ than others, but in general, big believer in holding lots of acreage over the long term and land that could be chopped up or value add or get your cost basis back over time and still hold on to some, et cetera. I think that data centers are going to continue to be a massive need, and real estate related to infrastructure like water and energy. I think those are critical as well, probably. And I think Blackstone said this week that energy is the thing they're allocating to most right now, where they just see the energy needs of AI and data centers just going through the roof.
Yeah.
So those are some areas that, it's definitely not a personal financial recommendation for anyone listening, right? It's but those are some things that come up fairly often with our clients.
Yeah, definitely more and more. And I feel like if you're going into the data storage area, you have to go into the energy area because they're going hand in hand. I mean, you're filling up things that need more energy. So you have to kind of be able to solve for both.
Right.
And then you can maximize both returns.
Yeah, for sure. I think the energy world's going to look completely different a decade now, 15 years from now, because of all the new discoveries that are coming out with mini nuclear reactors and fusion and stuff like that.
Yeah, I mean, how important is it for somebody who wants to create this legacy to stay on top of what's really happening? Of course, the political landscape is hard to follow because things are changing so quickly right now, but that will level out. But how these people who are doing so well over time and over your career, haven't you found that they really know what's going on without sitting and watching the news all day? They're staying abreast of the important things that could affect their investments and future investments.
Yeah. There's a couple of answers to that. One that's really helped me is if I'm spending time on social media, what I'll do is go out of my way to block annoying, obnoxious things. I will like and follow something about being a better husband, father, something on health, or a bunch of AI nerds or Ray Dalio and people that so I customize the algorithm based on going out of my way to share links and click follow and all that stuff, right? So that's one way to keep on top of these bleeding edge trends. So I knew DeepSeek had been released, and then 3 days later it comes to the front page of the Wall Street Journal, but just more in general, keeping up with what MCPs are and GPT buying Windsurf and how that's different than Cursor and what Flutter Flow is and all that in the AI world. I wouldn't know if it wasn't for me doing what I just said. So that's one thing about keeping up with it. But the better answer really is that I find these wealthiest families, they stay focused on dominating a niche or two, but then see how these new trends could help them with their primary third bucket of playing offense. But then they're also paying attention to these macro waves. I live in Hawaii, so we're out in the ocean quite a lot, and you get sets of waves coming in sometimes, and you learn to time the waves. And even if you disagree morally with sports betting getting approved in 40 states or cannabis getting approved in all these states or crypto, going from 2011, dorky, almost teenager kids telling everyone they should invest in it. And all the gray-haired real estate guys laughed them off the stage at my events. And I was like, well, that was interesting, but I didn't invest anything back then, and I should have. And then, so these families, they see sports betting, cannabis, crypto, and they see these waves of just enormous wealth creation. And it's been pounded into their head, now with NVIDIA, with the FANG stocks, it's been pounded into the family office's heads that you should at least pay a little 2 to 5% attention and put down a little bit on some of those things because you just feel a little bit silly not having risked, 100K on that. If you were worth 20 million at the time and put 100K into Bitcoin, it would have been bigger than anything else in your portfolio, maybe. So that's new, since it happened with crypto and cannabis and sports betting. That's in a lot of family offices' minds. Like, they have to have some allocation to this stuff that just goes straight up to the moon, it seems,
Yeah, and I think they're able to say, okay, if it goes to zero, it was worth the risk on it because it's a very small particle. Whereas if somebody's new, like, I wouldn't tell, I'm sure you wouldn't either, somebody brand new, they have 100K, like, don't invest that in crypto. I mean, that's all the money you have. Yeah.
Yeah. It's like Warren Buffett says, invest it in your own knowledge, your expertise, your capabilities, and figuring out what's a high value sandbox that you could work towards over 5, 10, 12 years and really be number one or world class or number one in your local area. That's where you should invest your money and resources. Like, when I invest into crypto, I have mostly Bitcoin, but I also have 120 other tokens and meme coins that will most likely go to zero, but like maybe one of them will surprise us and I'll be like, oh yeah, Shiba, amazing.
Yeah. Right. Ooh,
trillion of them or something. Right. So
yeah.
But I would lose zero sleep if all of the meme coins went to zero. If all the Bitcoins went to zero, I'd be a little sad and complain to my wife for a few weeks and then get over it. It's not like we're going to be stressed out. So I think that's how you have to approach those kind of wild, crazy areas, like 4% of your net worth or less, 8% or less. And that's how a lot of the families I work with approach it.
Yeah, but it's good to hear those percentages because I think somebody even with 100K in their bank account can allocate similar percentages to what type of risk they're ready for. So they know, okay, I don't want to burn it down, but I want to have some exposure to something that could be a rocket ship at one point.
Right. I would maybe be a lot wealthier if I took on more risk. But the other way to look at it is like a lot of my investor club peers have sold out or gone out of business the last 18 years and we're still here. So I'm very low risk. We have almost like no debt personally. We have no debt on our business at all. So maybe too risk adverse is what I'm saying. But that's just how I like to sleep at night. And I want to make sure that we build something enormous and we don't, like Warren Buffett says, like, you work too hard to want to start over. So he has the same mindset. He has very, very little debt. And then in a worst case scenario, he could put on low to moderate debt. And it's still less than other people's debt that they have all day long that they put on real estate deals, et cetera.
Yeah, and I mean, Buffett's a great example of him just not listening to anybody else.
Yeah.
How many different decades did somebody say, oh, Warren Buffett's washed up, and then he, proved everybody wrong every single decade that he's been alive.
Exactly, including right now being like flush with cash while everything's on sale. I think that's why he announced his retirement now, because there's no way that Berkshire Hathaway isn't going to kill it with almost anything they buy over the next bit of time. And he's still alive to be the chairman. So like the next 5, 7, 10 years, they'll probably look like geniuses, right? So
yeah, well, but because he followed his own formula the whole time and kept to it, no matter what anybody else was saying. Yeah, I was listening to something and it was about, him saying, I'm not interested in, the .com bubble at the time. And everyone went boom and then they all went bust. And he was just like, well, told you. Well, it was something about like, he's just comfortable just investing in like Wrigley's gum. Like it's just going to be fun.
Munger used to say like, it's not like baseball. You can watch 20 pitches go by and you don't strike out by not investing in things. Yeah. You strike out by connecting the bat with the wrong thing, So let some pitches go by. Like if for some reason you're not comfortable, like just don't do that deal and like wait for one that's very high conviction and you absolutely trust the person, etc.
Yeah, I found from the small scale all the way up to the large scale, if it feels off, you should pass, because if it turns out to be a winner, you just chalk it up to like, okay, maybe I got to see what that feeling really was. Maybe I was just scared, but it's just, there's nothing worse than knowing it's going to like really having a feeling that it's going to go poorly. And then you do it anyway and it goes poorly. You just like, you knew you shouldn't have done that. I think it's a part of what people are seeing. There's so much stuff that looks better than it is now that you really have to dig into that trust factor that we were talking about and operators and business history and returns. And, do you want 8% or do you want the potential of 16%, but also the potential that it goes to zero? You and I both just give me the 8% all day. It's fine. I'm fine.
Yeah, for sure. You have to find those asymmetrical bets in the counterparties as well, right? Like if you're a seasoned entrepreneur in a savvy family office, you have to think, is this entrepreneur across the podcast from me or the table from me? Like, are they like savvy? Have they learned all the hard lessons you have to learn? I mean, if your financial IQ or CEO IQ doesn't grow faster than your revenue or your net worth, then the world will self-correct it. And that's why pro athletes go bankrupt, lottery winners go bankrupt. It's like the world self-corrected the fact that their financial IQ did not grow as fast as their net worth, And so gravity will pull you right back down, and people will make very convincing pitches and take all of your money, So you have to be careful about that.
Yeah, and you were saying that at the beginning. I mean, these people who are at the highest level, they're getting pitched by everybody all the time. They've just learned to have many buffers in the middle. But, when you're a brand new person with that, you're going to get the pitches and think, hey, this is great. Everybody loves me. Oh, wait, they all want some of this money. That's why it's crazy, though. I mean, there's kids who made so much money, on TikTok or social media. They're definitely going to go broke, if they don't have any real management. Their parents probably have their hands in there. It's a scary situation for getting that much money that quickly without knowing really what to do investing wise.
Yeah, no one shows a bad pro forma, and you can model anything in an Excel spreadsheet. You can model world peace and have the math make sense, right? And it's it doesn't matter what your spreadsheet says, right? It's just spreadsheet math. So I think you have to be super careful.
Yeah, and spreadsheets, I mean, I was a spreadsheet nerd when they first came out. And I think the funniest thing about spreadsheets is you can just tip one number by just 0.1% and the whole deal goes wrong. Right. So how important really is a spreadsheet versus what and what the asset looks like? The spreadsheet is important, but it's not the spreadsheet isn't connected to the asset. It's not 100% guarantee that what's on these numbers on here correlate to what's there, because there's always, happenstance that comes in the way.
Right. I think that's why people come to an event where they could hear 50, 100 people on stage. Because even if you were new and then you decide, okay, I want to go look at 100 real estate deals. After looking at 100, some are going to make way more sense than others. Some will be way more polished, more articulate, more trustworthy, more right in your backyard. So you can walk the property yourself. And investors need to go through that learning curve before they just start firing off, $1 million checks. And sometimes it's just not how it goes, right? So a lot of wealthy lose 20, 30% of their wealth, and then they realize they need to formalize their family office, have a more focused strategy. And a lot of people have that pain right now.
Who should form a family office?
Well, there's three types, and, a virtual family office is just a really lean, you outsource almost everything form of a family office. And so people with $7, $10, $15, $20 million put together virtual family office solutions. Basically, when they get past the point of maybe renting out their old condo and a vacation home or something, and they get beyond just some stock market investments, and they start doing angel deals and direct real estate investments and funds, then that's one hint that you might want to formalize into a virtual family office on some level and at least plan things more holistically. And then, typically for every 50 to 70 million net worth, you're typically hiring one full-time professional, unless you really just want to stay passive and lean. And then you might just have employees within your operating companies and hire a multifamily officer or wealth advisor or two.
Yeah, I mean, it's interesting. So who's in the family office club? Because you have over 100,000 members. Are those all people who are members of family offices?
So basically what happened is we had an offline networking group called Family Office Club. We moved it onto a social media platform that doesn't exist anymore, and it wasn't working too well there. So we moved it onto LinkedIn. And so our Family Office Club networking group on LinkedIn, I think now has 140,000 members in it. But they're just LinkedIn group members, right? And we run, 5 groups, and we've got the 15 million people in there. They're just LinkedIn group members. The people who are actually active investors in our investor club, there's about 7,500 investors total. And I would say that there's 1,000 that are most active. So there's about 1,000 decamillionaire, centimillionaire types that are investors. And then we have about 700 paid subscriber members who are trying to access those investors and meet them at events and speak on stage and access our investor portal to network with the investors. And so that's how the business model works, really.
Yeah. And I mean, where do you want to take it from here? I mean, you've been really successful growing it. You said you got out of a basement apartment and turned it into this, and the events are really crazy. I've seen, speakers and guests there. It's really an unbelievable lineup of successful people.
Yeah, I mean, there's really 3 points to like the moat that we're really trying to build around Family Office Club going forward. One is we're growing our social media reach from 17 million to 100 million. We were at just 3 million maybe 3 years ago. So we're trying to grow that to 100 million. I think that'll put a big social media reach moat around us. The second area that I spend the most time every day is artificial intelligence. So we've got 30 artificial intelligence tools that fully work, very practical, take no setup to get working. And we call that investor superintelligence. And so we tell people, if you want to plug into superintelligence and gain superintelligence, you can literally have conversations with the collective intelligence of 1,000 billionaire talks that were given publicly. And we transcribed all of those, or 1,000 deal structures. Tell it what you're solving for, and it will give you 10 deal structures. And so we have 30 different examples like that. So AI is the second thing. And then the third thing is I bought billionaires.com after negotiating that for about 12 years. I bought that about 3 years ago.
Yeah.
So I've interviewed 45 billionaires. We're going to interview 100 in total. We have them on stage at our events. And I think that, I hope it doesn't take me 18 years to make billionaires.com amazing, because that's how long it's taken me to grow Family Office Club. But, maybe we can do it in 8 years. And once we get billionaires.com, like a standout top 3 website on mental models for billionaires and strategies around how they think and act, that's like the 3-point moat that I'm working really hard to build. It's like the 100 million, the AI, and the billionaires.com. And importantly, it's related to everything we just talked about, this whole conversation, right? Like, I don't see anyone else playing that game in the investor club world. And we've been at it a long time. And it's a unique way to force appreciation and add value first. And so hopefully when people hear that, it's kind of like, oh, okay, well, like, what's the 1 to 3 things I'm doing where there's like literally almost no one else playing that same game? And then you can apply that to your balance sheet.
Yeah, I mean, the AI models based on the talks that people have given at your events just sound genius to me, because you're basically getting the collective advice of the smartest people, all at once, coming through this new person, this, identified person of 100 people. Yeah. And I mean, as we can all see, AI is just going so quickly from a time where I was like, oh, I'm not really going to need to use this. And then I'm like, okay, I better figure out the best way for me to use it. And I think that's really what everyone's trying to figure out.
I'd love to give you free access to a couple of the tools just to play with for fun. Like, there's 2 crazy things about it. Like, one is we have a tool called Dewey, Instant Due Diligence Advisor, and all these are free with membership. It's not like we sell these. And but you can literally take a 144-page PPM, and even if you read every single word and you were a lawyer and understood it and your eyes didn't glaze over, it'll identify missing sections, red flags, and smart questions you can ask. And like you and I were talking about saving time, when someone pitches you a deal, you can just upload it to Dewey, have it identify the top 7 questions you should ask, email back those 7 questions, and they may never even take the time to answer. It's like,
they're like, oh, they know.
Like spend zero of your brain power until you first use Dewey. And then if they actually answer them half intelligently, okay, maybe you should lean forward. But like that might sink the deal right there. And then the second thing is that MIT and Harvard with BCG Consulting did 2 different studies with 1,000 people and found that AI copilots grow your IQ by an effective 12 points and make you 33% faster. And so they've proven that with 2 different groups of knowledge workers. And so it's like, do you want to be 33% slower? If not, you got to build your own AI tool set built just for you, because these generic off-the-shelf tools are highly technical or half work, or they weren't built for you at all. And it's kind of like I'm just wasting my time here. Cancel it. So that's where the AI world is right now for my eyes,
Yeah. Wow. Amazing. Yeah, this has been a great show. I really appreciate you spending the time. Where's the best place for people to get in touch with you? I think it's at familyoffices.com.
Yep. Familyoffices.com, and my WhatsApp number and text message numbers at the top of the website. So try to get back to everybody super fast. If you need a link to something, or a link to a book or a mini series that we put out, or something, that we've got tons of free resources, just like your podcast. It's all about, adding good karma to the world, and then things come full circle eventually.
Yeah, I mean, your story is that. Lead with value, and then look what you turned it into. Basement apartment into this gigantic institution that can help everybody learn how to get where they want instead of just kind of staying stuck.
Right. Yeah. It's definitely exciting and motivating. Like when you hear from so many people that are like winning, it's the opposite of watching like mainstream media. Which is kind of like, oh my God, what depressing things have happened today. Oh, look at that scandal. It's like, it's totally the opposite, right? It's super optimistic. exciting, like American dream kind of themed without being overly rosy. Like people will talk about how they lost millions of dollars in a deal and don't ever do this or don't do that. So they're pretty genuine and authentic, which, that's the fun part of it.
Yeah. Well, amazing. I appreciate you spending the time. It's been a pleasure.
Thank you. Appreciate it, Jonathan.
All right. That was Richard Wilson. He's the founder and CEO of Family Office Club. Again, you can find him at familyoffices.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you could get a preview of who's coming up on episode 262 of Zen and the Art of Real Estate Investing. It's the mad scientist of multifamily, Neil Bawa. He's one of the most in-demand speakers in commercial real estate, a data guru, a process freak, and an outsourcing expert. He has a $660 million multifamily portfolio, and it's really an ongoing experiment in efficiency and optimization. We'll see you next episode with Neil.